Let's move on to markets in Kenya, and of course we have seen a downward trend in those markets for the past 10 odd trading sessions. Just looking at the NSE 20 today, slight uptick, but of course pretty much flat and certainly off the highs that it reached earlier this year, just 4,705 points. Looking at how the currency is faring, certainly also being under attack and under pressure. Attack pretty much over exaggeration perhaps there, but it still is trading at this 13-week low against the US dollar, which has been on the front foot against most major currencies. 85.55 is what the shilling is trading at this hour. Let's get an update on the markets. We're crossing over to Nairobi. Kenneth Manjeri, fixed income and money markets analyst at Stanlib Kenya, is standing by from our studio on that end. Kenneth, thanks for joining us today. So just give us your views right now on the sentiment towards Kenya's market, given, of course, the market has been under pressure, under a lot of pressure in the past few trading sessions. We've got the shilling, which hit a 13-week low. And, of course, there's also uncertainty around new taxes. But what do you see as the key driving forces right now guiding sentiment?
I think what's driving sentiment with local investors is basically the exit we've seen of foreign investors on both the fixed income and equity space. We've seen, big sell-offs in the equity market on large caps, EABL, Bamburi, BAT. This has depressed the market, Safaricom. And so that's why we've seen the market coming off. Today, you would say there was a slight uptick. Mostly, I'd say this was driven by the slight upward movement we saw on Safaricom, mostly from local investors. A lot of the foreign investors are still sitting out, and it's actually quite a worry because even for the shilling, where if we see an exit of foreign players, probably they book in their profits for the year, considering how much the shilling has lost ground, considering the market is up, I think, about 16 to 18% year to date. So if they were to decide to book in their profits, it's quite a worrying trend. We'd see a lot of that activity on the market come off quite a bit.
And concerns like yours have also been mirrored with by the World Bank's head today, Jim Yong Kim, basically saying that they're concerned about the spillover effects of the Fed tapering back on quantitative easing, investors looking for new places to put their money, perhaps pulling their money out of emerging markets. They're concerned around capital outflow from emerging markets, developing markets. And of course, Kenya, we've seen, has not been isolated from the situation as it's been playing out. Are you watching what's taking place in the United States when it comes to quantitative easing and thinking about how this is going to affect the Kenyan economy?
Yes, it's quite worrying. We're seeing a lot of, actually, those are the funds that are leaving the country at the moment. I think it's referred to as hot money. So that's the money that had come in, and really a lot of it had come into the Kenyan fixed income market, chasing yields, into the equity market, looking for high returns from the frontier markets. And most of them, in dollar returns, you'll find year to date have made upwards of 20% return. They actually can, and also we are approaching, I think we're actually in the summer holidays, according to the West. So a lot of them by this time have probably hit their targets, and we may see them come off, especially if the Fed eases back on QE. So it is quite worrying, and also for our shilling, because the support we've been seeing for the shilling has not only been from CBK's movements on the open market, it's also been a lot of this hot money coming into the country from, I think, actually from the beginning of the year. It's acted as quite a large support for the shilling. Yeah. And if this money is pulled out, it's quite worrying, especially with the positive growth sentiments we have for the second half of this year.
Let's throw forward to next week. What are your expectations when it comes to the 5- and 10-year bond auction, given that we have seen foreigners pulling out of the bond market, given we've seen shilling weakness, and we've started to see that sell-off in bonds, specifically on the long end of the curve?
Especially on the 10 years, you've mentioned the long end of the curve. The 10-year, I think we should expect quite aggressive bidding. The foreigners have actually been selling off those tenors. They've been selling off between 5 to 15 years. And we've also seen quite a number of, quite a bit of sell-off on the 10-year tenor. So we should expect they may not come in so aggressively for this auction, leaving a lot of it to the local investors. I think local investors, considering the way the market, the slight uptick we've seen in rates of about 60 to 80 basis points in the last 2 weeks, may go in for this bond quite aggressively. We may see levels as high as 12% on the 10-year and anywhere around 1150 to 1180, 1190 on the 5-year bond.
Yeah.
2 weeks ago, these papers were trading southwards of this by about 60 basis points. The 10-year had almost hit a low of 11%. So and the government will actually be looking for a much larger amount, about 20 billion in this auction, compared to the last auction where they're only looking for 10 billion shillings. And I think bidding will be quite aggressive in this auction.